Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the crazy auto loan bubble update. There's been some crazy things that have happened, but a couple months ago, I made a video with a guy named Lucky Lopez. He's the guy that accurately predicted the auto loan bubble, and I learned the crazy truth of what's happening in the auto loan business behind the scenes. So first, I learned that Americans owed roughly $1.46 trillion of auto loan debt. And that represents roughly 9.4% of all consumer debt, right up there with student loan debt at 10.1%. Now, that's partially thanks to the fact that car values went up 42.4% really fast at an unsustainable rate. And thanks to the chip and inventory shortage we were told exists in the market, is also why 82 out of 100 cars were sold over MSRP value this year in 2022. The reason that number should blow your mind is because last year in 2021, only 3 out of 100 cars were sold over MSRP value. And crazier still is the year before that in 2020, it was less than 1 out of 100. And this blew my mind because cars were never supposed to be appreciating assets. But thanks to the skyrocketing values at unsustainable rates, is why the average monthly payment for a used car is now up to $515 and $667 for a new car. It's also why roughly 1 in 12 Americans are more than 90 days late on their car payments and why 1 in 8 cars are being repossessed. Now, to show you just how big the scale of this problem really is, Lucky and I went to a repo yard here in Las Vegas, Nevada, and what I found was that there was not a shortage at all. In fact, there were thousands and thousands of cars just sitting on the lots. Now, to recap how we got here, remember, it was how money was lent out during the 2020 and 2021 pandemic, because that's when people were getting their stimulus checks. But believe it or not, roughly 96% of borrowers didn't even have their incomes verified. If anything, they were approved for higher than normal LTV or loan to value ratios. For example, before the pandemic, the average subprime bank would loan roughly 80 to 90% LTV. But thanks to the chip shortage and the supply and demand, cars went up in value. Instead of stabilizing their LTV, they actually increased it to as high as 145%, which means a car that was worth $10,000 before the pandemic became worth $14,500. Normally, those banks would never lend their money on that, but they started to. Now, since all of that has happened, there's also been some really crazy stuff happening behind the scenes. First, LTV ratios have actually come down to between 90 and 105%. Second, wholesale prices have actually come down at the rate of 1% per week. It's insane. But car prices for the consumers have not come down. In fact, in some cases, car prices have actually gone up, which doesn't make any sense. But that's because dealerships are in trouble. They also paid more for those cars than they are worth today. And third, both dealers and banks have stopped buying auto loan bundles. And this will have a huge ripple consequence on not only those banks, those dealers, and of course car prices. So with that said, I want to invite Lucky Lopez back on the channel to help explain everything that's happened since our last video and why car prices haven't come down as fast as they should, when they might, and why dealerships are about to be in big trouble. So with that said, let's get right into it. All right, so here we have Lucky Lopez with us. Thank you, Lucky, for coming on. I appreciate you.
Thank you for having me.
Yeah, here's a... Anyway, I have a lot of questions for you because why haven't dealerships lowered their car prices as much as we'd like?
So the reason why dealers don't lower their prices is because they actually can't. So I'm gonna show you why. So there's this app, it's really cool. Nobody gets to see this, none of the public, only dealers. So now we're gonna pick a car that people can relate to, an everyday vehicle.
A Bugatti Chiron.
100%. So we've decided to pick a 2021 Mazda 3. Now the first slide we're going to show you is what's called the retail market view. This is going to show how many of these vehicles are actually for sale in our market. And here in Vegas, there's 5 of them. On the low end, the cheapest one that's selling here in Vegas is selling for about $30,000. And if we look at the high end, it's $32,000. Now keep these numbers in mind. These are retail numbers. The next slide we're going to go to is what's called the market report, MMR. This is what dealers and wholesalers pay at the auction. So on the low end, it's $26,000. On the high end, these cars are going for around $29,000 at the auction. So our average MMR price is $28,000. Remember, this is wholesale. If we compare our $28,000 to the highest retail, we have maybe a capability of making $4,000 profit. So the reason why dealers are not lowering their prices is because $4,000 seems like a lot, but I'm gonna show you why it's not. But first, a word from our sponsor, and our sponsor today is the economy and stupidity, because without both of these things, none of this would be possible.
We actually have a second sponsor too, but it's a lot cooler than that. All right, so why are we talking about underwater auto loans if we're invested in stocks, in crypto, and we're not blowing our stimulus on Mini Coopers, right? It's because shareholders, aka people like us, could be the ones left holding the bag, because now the banking system, the bedrock of the economy, is in too deep and could start showing signs of cracks. Because Capital One, for example, is already down 31%, and they have huge exposure to these types of loans. And defaulting on loans, warning indicators, and countrywide crisis, it's starting to sound a lot like 2008. And I'm not saying it's gonna be 2008, but hey, did anyone living through 2008 know it was 2008? Now, I sure hope that's not the case, but the point is, the average retail investor is down 44% year to date, according to JP Morgan, and even the most cautious, those with a 60-40 portfolio, just had the worst year in the last 100 years because they're down 34%. Now, big banks and institutions like Goldman Sachs have usually been ahead of the curve, which is why they're telling their investors to shun most stocks and instead try to invest their money into alternative assets to prevent further losses. And one of the alternative assets they suggest to look into that could help your portfolio potentially outperform the rest in this crazy new volatile economy is fine art. Forbes reports there's never been a better time to invest in art, and it looks like they're right on the money because Morgan Stanley released a report saying that the average piece is selling for 26% more at auction as compared to last year. And that's how Masterworks has strategically managed to deliver exceptional results even in 2022. In fact, 6 of their 7 exits have delivered over 20% net returns to their investors, and this is while the average retail investor is seeing 44% losses. Masterworks has even had a sale as recently as early October this year for a 21.5% net return. And as a result, Masterworks has had to acquire and release more art on their platform, and why there's a wait list for new users. But you can skip it just by clicking the link in the description below the video to join the thousands of my other subscribers that have already done it, and it's as easy as a click away. So thank you, Masterworks, for sponsoring this portion of the video, and now let's get back to it.
So here is our beautiful 2021 Mazda 3. Now, this thing has a wholesale blue book of $28,000. but has a retail book of $32,000.
So $32,000 is the price I would pay as a consumer, and $28,000 is the price you would bid on at an auction.
Correct.
Okay.
So let's say we purchased this for $28,000. So we're gonna get an estimated $4,000 profit. So we need to pull out our $4,000.
I just so happen to be prepared. We have $4,000 right here. So just to show you visually what this looks like, because it's pretty mind-blowing.
Yeah, so every dealer at this point is gonna think that they're gonna make $4,000. But
Right.
the second you buy it, we're gonna have what's called an auction fee. So I need you to peel off $300.
All right, so 1, 2, 3. That's going over there.
All right, so now that we got that out, well, most dealers do not have the capital to carry these cars themselves. They have flooring lines or lines of credit. So it costs money to put them on there. So I need you to pull off another $200 because we're gonna be adding it onto our line of credit.
200, all right, 500 down.
All right, now it's official. We paid the car, it's ours. The first thing dealers do is we take it to the dealership and we do what's called recon. We go over the car, we look and see what it needs to get it frontline ready. So the average recon on a used vehicle is around $1,000. So I need you to peel off $1,000.
That's a whole pile.
Yeah, exactly. So now all we have to do is detail it. I need you to pull out $200 so they can wash it, detail it, and correct the paint.
Okay, 200 right
So
there.
there's $200. So now it's officially frontline ready. It's ready for sale. So what do we have to do now? We have to put it on Car Gurus, Auto Trader. We need to put it online, and that's going to cost us about $500 and a marketing budget. So we need to pull off another $500.
Jeez, $500, okay. So we are left with, I don't know, 1,800?
Yeah, not that much. So now it's ready to go. It's up for sale. It's been about 2 weeks since we bought it, and we get our first cash offer. The gentleman is offering us $31,000. We're asking 32, but he's offering 31. So let's take $1,000 out of there. And what is our profit today if we sell it for $31,000?
All right, so that's $1,000. If we sell it, it'd be 1, 2, 3, 4, 5, 6, 7, $800.
Yeah, but it doesn't make sense because they wanted to make $4,000. So now we have to reject this offer because that's not enough money. So let's go ahead and put that $1,000 back into the pile.
Okay.
So we already hit day 31. So now we have what's called carrying costs. I need you to pull $100 out for detailing and gas.
Okay.
I need you to pull out another $100 for marketing,
Okay.
because it keeps going. And then I need you to pull out another $100 for our flooring line and our interest costs on our lines of credit.
Jeez, okay.
So now we're gonna put it back up for sale, but you can see these costs keep recurring every single month. So now let's fast forward to say we get a consumer that's not really well qualified, he has bad credit. A lot of people don't understand this, but when you purchase a car, the banks actually charge you money to do an auto loan. So let's say this customer agrees to pay our full sales price of $32,000. So, but the bank's going to charge us the $1,000 out of the actual deal. So let's take 1,000 out.
1, 2, 3, 4, 5, 6, 7. 1, 2, 3. That leaves us with $500.
So even though we're getting full asking price and it's been another 30 days, we're losing even more money. So now we have to turn this deal down again. So let's go ahead and put the $1,000 back. We're going to tell the customer we can't sell them the car.
And that's not even counting the commission from the salesman.
Correct.
All right, so we've got $1,500 again.
Well, bad news, we turned down that deal. Now we just hit day 61. So I need another $100 for detailing the car and putting gas in it.
Jeez.
I need another $100 for marketing the vehicle. And I need another $100, remember, because we bought this on credit. We have to pay our payments of interests and everything else. So add another $100 onto there. So we're at how much now?
$1,200.
And that's if we sell it for the actual mark. So what dealers are doing now is they can't take this big loss. So instead of lowering the price, they're actually raising the price. So a lot of consumers are complaining that the prices are going up instead of down. And as you can see from this demonstration, the carrying costs and everything else is what's bringing the price up. So our car went from $32,000, now it has a retail of $33,000. Every month this goes on and it snowballs out of control, and the dealers cannot afford to lower the price because they have so much money invested into it.
That's crazy. That explains a lot. And I remember learning in one of your videos that the average holding time for a dealer was 45 to 60 days, which is how much time they had to sell to a retail customer like myself. But if they couldn't, then what's their incentive to keep holding onto that car and paying those recurring costs?
During the pandemic, it taught a lot of dealers bad habits. They were so afraid of selling the inventory and not being able to replace it, they winded up holding onto the inventory and getting buried with reoccurring costs.
All right, so if dealers can't sell their cars within that 45 to 60 day time frame, what happens then?
And this is where it gets interesting. So we're gonna bring back out our 2021 Mazda 3. Now remember, this has a wholesale book of $28,000. So we're gonna take it to the auction and see if we can get that money for it. But you gotta remember, the dealer that bought this before already put several $1,000s into it with recon, carrying costs, and everything else. But now with the economy slowing down, demand dwindling, and interest rates going up, the demand for these vehicles are less. So dealers like myself are gonna offer much less than that. So we're probably gonna offer $26,000, $27,000. So as this car runs through the auction lane, I'm gonna bid $26,000, $27,000, and it's gonna go what's called a no sale. The dealer is gonna turn down my offer because they're into this car, let's say $29,000 or $30,000. And this is a big dilemma that's happening now, is because half of the cars run at the auction today are what's called no sales, cars that don't hit the reserve. All these repos that are coming in every week, and they're running. Along with the cars that are going for no reserve met, this is causing a massive snowball in supply, which is going to bring down demand, which is going to hopefully lower prices for consumers.
All right, so now I want to talk about the finance side of things using CarMax as an example, because whatever happens to CarMax, chances are it's going to happen to the whole rest of the industry, because they're the largest used auto retailer in the US. And you made a video recently about them, about what they said their income losses were expected to be, which is crazy because so far their income is down 8.6%. And that's not the crazy part. The crazy part is what they said about something called CECLs, which are the current expected credit losses. Because last year, it was roughly $35 million. But this quarter, they increased it to $75.5 million. So can you kind of explain what that means and how is that going to affect the market?
So CECL is a preventative measure they put in place back in 2017 to help banks keep liquidity if they have unexpected losses. They don't want another bank bailout like they did in 2008. And the reason why this is such a big deal is because it's affecting the way banks lend. They're always trying to offset their risk. So as of right now, remember in our last video, they were lending 130, 140% of LTV. Now they've dropped down to like 110, 90% of LTV. They're shortening the terms. There is banks out there doing 96, 84-month financing. Now we're seeing the average drop down to 60 to 70. The loan amounts, they're not giving the crazy amounts of what they used to. They're changing restrictions as far as income. You got to verify it, prove it, show a track record of 6 or 7 months. Also with other qualifications like job time and how much money you're going to be putting down. All these factors are playing a massive role in this credit crunch, and it's making it harder and harder for consumers to get qualified for vehicles.
So I guess what all of that means is that dealers will not be lowering their car prices anytime soon just because they can't, because they paid more for their cars than they're worth. And even though wholesale prices are coming down, they won't lower their prices because they just can't. And for consumers with excellent credit, they'll have a harder time getting a loan because of this credit noose or credit tightening you've talked talked about, and that's for people buying a new car. But for people buying used cars, they won't be able to refinance or trade in because they're upside down on their cars because they bought in 2020 or 2021, so they also paid more for their cars than they're worth, so they just can't refinance or get anything out of it, which means the only thing they can really do is just walk away.
Exactly. The only people that are winning are people that either pay cash or put really large down payments.
Where do you think the car market's gonna go in the near future?
I think this is only the beginning because one of the largest dominoes is about to fall. We're waiting for Carvana's numbers that come out November 1st. They're gonna show massive losses and probably go into actual bankruptcy or go out of business. And that's gonna have major ripple effects across the entire automotive industry. So what we're advising people now is not to purchase, to wait. We believe you'll get an extra 5 to 10% off your pricing if you purchase around Christmas time.
Well, thank you so much for coming on. You can find Lucky's channel on his YouTube page. I'll leave a link in the description below. Appreciate it. This was pretty crazy. Smash the like button, subscribe if you haven't already. Don't forget to grab up to $250 worth of free Bitcoin right here. Don't forget to put it offline, grab your free stocks, links are down below, and then go track them automatically with a spreadsheet link down below in my Patreon. Love you. Thank you so much for watching this video. I'll see you back here on Monday, Friday, sometimes a Wednesday. I'll see you soon. Bye-bye.